have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets. Where's the gold?
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. Thank you for tuning in. If you have not already and you want to hear more about precious metals, mining, economic freedom, please do consider subscribing on whatever platform you are listening on, and also go to our website, goldnewsletter.com, for our paid publications. Now, we have Jordan Roy-Byrne today. He is the editor and publisher of thedailygold.com. He is also a CMT, that's a chartered market technician. So someone like him, he has a lot of wisdom to share at this time. Now, my understanding is you are actually looking more into Fed action. So I guess you're getting a little bit away from your strict expertise. But why are you focusing so much on, let's say, Fed rhetoric and actions in terms of your gold and silver price assessments?
The short answer is because if we look at the last 50 or 60 years, the Fed starting to hike rates or starting to cut rates or stop, when they do their last rate hike, the market tends to bottom. I mean, it depends what kind of cycle you're in. Is it, more disinflationary or inflationary? But regardless of all that, generally speaking, when we look at the last 60, 70 years, when the Fed changes their policy, that tends to coincide with a change in the gold market, be it could be a peak, or it could be a bottom, or it could be the start of a big move. So that's why I'm really focused on that. And I think that, I know we'll get into it, but I think that, my view for the balance of the year is I think the Fed is going to have to cut rates. They're going to go from hiking to cutting really quickly. And I think that's going to be has potential to be just a earth-shattering type moment for precious metals when they do that. So that's I'm following it, and that's my view right now.
Yeah, and tell us, what do you describe as a change in policy? Is it a reversal of rhetoric, a departure from expectations, or any basis point change?
That's a really good question. I mean, the market tends to sniff these things out like before they happen, but generally, I'd say a shift in policy is they go from not hiking to they start hiking rates, and then they go from we're going to pause hiking or we're going to stop hiking to eventually cutting. So it could be one of those.
All three together, pretty much.
Yes.
Yeah. But your big observation or expectation is that pressure over, let's say, recessionary indicators, right? Let's say that unemployment starts going up, inflation is still high, growth is low, will make the Fed even more politicized than it currently is?
Well, I think it's always been politicized. I mean, even going back to the early 1970s, and it's been reported that President Nixon at the time told them to cut, I think stop hiking or cutting. I forget what it was, but that's been well reported. So I think if the economy becomes an issue, then obviously the White House, who's ever in there, is going to apply pressure on the Fed. Obviously President Trump was talking about it several years ago, that they were hiking too much and they needed to cut. And then obviously now when inflation became the number one issue, then you started hearing, President Biden, in the Fed, you would hear them together in the news. So inflation's the number one issue. So of course the White House will then tell the Fed, hey, you guys got to hike, start hiking rates ASAP. And if in Trump's case, the economy was weak, so he wanted them to cut. So I think it's always been politicized. I think it could appear to be more politicized, in the months and quarters and years ahead, just because the economy is going to be very volatile and overall not that strong.
What about the fact that right now, yes, if the executive branch in the United States pushes the line that inflation is everyone else's fault, including the Fed's fault, won't that almost embolden the Fed to say, oh, yeah, you think it's our fault? Okay, we'll give you a piece of that. We'll really cut down inflation, but make it hurt on you. They'll almost get vengeance on the president.
I don't think so. I mean, I think the Fed, the White House appoints the Fed. So I think they can, if there's criticism, I think they can handle it. I mean, they know it's a political job. And if there's a problem, politicians will obviously point fingers in the other direction. So I think there's so many problems now that have been building up that I think are going to come to the surface that I think we're going to continue to see that, regardless of who's in power, there's going to be a lot of finger pointing, a lot of blaming.
Right. And so, but you said, and rightly so, that there's so much scrutiny to Federal Reserve activity, right? Everyone's sniffing around. If that is the case, I assume pretty much before things even happen, we'll see changes to precious metals. Now, you do focus almost exclusively on gold and silver. What is this, let's say, earth-shattering breakout? Because I hate to say it, I've been doing this podcast for 5 years now, and often we talk about these breakouts, and we think, oh, yes, it's coming. And the last year, of course, has been pretty brutal. So what magnitude are we talking about, and how early would we see such a change come about?
Well, the breakout, I think, will happen, or it will happen a couple, potentially a few months after the Fed starts cutting rates. And the long-term view of gold is in a super bullish cup and handle pattern. And we don't see that many of these over this long of a time frame. So the cup was 2011 to 2020, and we've been building the handle consolidation. And it's a super bullish pattern, the way it's set up from a bird's eye view. The right side of the cup is a little bit higher than the left, because the peak in the left over the left side was 1900 or 1920, depending on if you're using closing prices or intraday. And then on the right side, it was, I think, 2070 or thereabouts. So you have normally when you're looking at a cup and handle, it's flat. The left and the right side, they tend to be kind of flat or really close to each other. In this case, the right is a little higher, so that suggests there's more strength than usual to the pattern. And then the handle, with a cup and handle, normally it only retraces 38% of the preceding advance. For gold, that's about 1670, 1675. So gold did come down there and test that for a little while, but for the most part, over the last nearly 2 years, gold, I'd say 97% of the time, gold has been trading above, materially above that 1675 support level. So you put all these things together, it's a super bullish pattern. But a 9-year long cup, that's not something that's going to break out in a year and a half. I mean, it could take potentially even 3 years to break out, or 3.5. We're nearly 2 years into it now, but I think over the next 6 or 9 months, we're going to come into a period where it's going to be really ripe for that breakout to occur. So I'm fairly confident, I think, in the next 12 months, we are finally going to see that breakout. And there's many reasons why. The macro is setting up. The problem earlier, you go back a year ago, the stock market is still going up. The economy was doing well, at least statistically. You had growth, and gold was never going to break out and launch out of that pattern, while the economy was growing and while the stock market was performing well. It's only going to happen when those things are performing poorly, and the Fed has to, cut rates. It makes a lot of sense, because historically, when they cut rates, that's the majority of the time that's been a turning point for precious metals. But as far as the significance of the breakout, this is a multi-decade breakout. So this is extremely significant. You hear lots of people in our world, they're always talking about a breakout, but those are tiny breakouts. They're not that significant. And if you look at the S&P 500 and you look at gold and you just go back over the last 100 years, each has had like 3 or 4 really significant breakouts where there's a breakout and then there's a huge move for at least several years after that point. If you look at The S&P, for example, I think the late 1940s, it had a cup and handle, and it broke out of that, and that triggered a huge move for years and years. We know that 1982, the Dow, it had a 16-year consolidation, broke out in 1982, had a huge move for 5 years. Eventually that move continued until 2000. With respect to gold, it's a little different. The gold price was fixed for 35, 36 years from the mid-30s until 1971. So that was a huge move when it broke loose out of that, and we let the gold standard go. The next big breakout was 2005, where we had a slight downtrend for, I think, 25, 24 years or so. So when gold broke out of that, when it got up to 2 and above 500, that was a multi-decade breakout. So the third most significant breakout is coming, and that'll be when it breaks out of this cup and handle pattern. And so it's, the measured upside target is 3,000. The logarithmic target, which is a percentage, is 4,000. And I looked at historical cup and handles in various markets, and there's like less than 5 of them. And in every case, they all went beyond the log target. And the other point is it all took them 6 to 12. Once they hit the measured target, it took them 6 to 12 months to hit that log target. So, we haven't broken out yet, and I don't think we're like a month or 2 away. It's probably going to take a little longer, but we are getting to that point. Like, the market is fast approaching a point where we could see some really exciting moves over the next couple years.
The Gold Newsletter is proudly sponsored by Inventa Capital Corporation, a venture capital advisory firm dedicated to the acquisition and development of assets in the natural resource sector. Today, Inventa is one of the premier mining groups with a first-rate portfolio of companies and a world-class team.
This is the Inventa Mining Update. I've got Cherie Leeden of Gold Bull Resources. That's just goldbull.ca. The ticker on this is GBRC, or over-the-counter GBRCF. There's a lot going on with her company. They are primarily in Nevada. She's an Australian, bringing her expertise from there. Now, I know you're changing tack a little bit with the organization. You've divested some properties, and you're proceeding ahead, let's say, with less exploration, more actual bringing mining to fruition. So do you want to clarify what that means?
Yeah, sure. So we did divest our non-core Bulgarian assets last week. We've now are a major shareholder of Raiden Resources, ASX-listed company, and there we've got further exposure by those assets, which had just been sitting in the company dormant when we took over Gold Bull Resources. So that's a value add, circa at the current value, $350,000 worth of shares in Raiden. And we're very actively drilling right now. We have a drill rig that's currently putting holes in the ground at Sandman in Nevada. We're 3/4 of the way through that program, and we're very much looking forward to the assay results that are going to be stemming in and coming through the next couple of months. That program was designed at adding some easy ounces, and also at exploring for some new targets. So we're very much, eagerly awaiting those assay results to see if we hit our new targets and how many ounces we added. And then in addition, we're now starting to contemplate a scoping study that looks at essentially the economic viability of our existing resource. We already have 500,000 ounces at Sandman, and I'm pretty confident that that's grown since that last resource estimate was put out there. And given that we're in Nevada, we're in a mining-friendly jurisdiction, it doesn't take too much to wrap around some scoping study numbers to really determine what a feasibility study is going to look like. So we have a couple of different scenarios that we intend to investigate at Sandman.
Yeah, do you want to give us a little bit of a sense for the timeline? So in the next few months, you'll be getting more drill results. And let's say, do you have any idea when that feasibility study might come in?
Well, we're actively still drilling now, so we can't really complete any studies until we receive all the assay results for this current drill program. We've got about another 1 month of the current drill program, and then say another 2 months for assay results. But in the meantime, we're looking at a scoping study that investigates 2 mining options. The first is a heap leach scenario where we look at mining the oxidized gold all above the water table and essentially have a central heap leach facility with our 4 resources feeding into that. And the second scenario that we'll investigate is mining the high grade, essentially outcropping gold from the surface, selectively mining the high grade portions and toll treating that at another facility. So essentially very low capital costs in that scenario. So I've got a couple of engineers taking a look at both options, and then from that, their feedback, then we can select which one we really focus on to commence a feasibility study, and ideally Q3.
Do you want to talk a bit about why you favour this more Australian approach of getting started on the mining earlier rather than waiting, as maybe North Americans are accustomed to?
Yeah, the current market for the junior space isn't great. And in my opinion, it's easier to raise development capital than it is to raise exploration capital. And Sandman requires more drilling to get a bigger and bigger resource. Essentially, the more we drill, the more ounces we're going to define. These big epithermal systems, such as Sandman, it's a pretty clear correlation between the number of meters or drill holes and the number of ounces. So there comes a point where you have to decide how many ounces is enough to push the go button on a feasibility study and ultimately make a decision on production. And in Australia, the Australian model tends to be start small and grow and essentially generate cash flow from small scale operating mines and reinvest that cash flow into both mine expansion and into exploration. And it's a model that we've done in the past, and it's a model that I like because it preserves our shareholders, including myself, against dilution. And I think in the current market, being cash flow positive is really going to be critical and key over the coming years. And I'm very bullish on the gold price. With inflation going up, it doesn't really make sense that gold is going down. So I'm predicting that's going to be a short-term blip.
Yeah, I'm right with you on that. Of course, I think it's crazy that during this period of such high inflation, we have seen a depressed junior mining sector. It doesn't make a lot of sense, and particularly as cryptocurrencies have floundered so badly. I mean, obviously, the natural alternative is to go back to traditional hard money or physical metal. So we will pick up this story, and I guess in a couple months' time. Cherie, I've been missing chatting with you. So people go to goldbull.ca for more details. Was it GBRC? Let me get the ticker here. GBRC is the ticker. GBRCF on the over the counter. Otherwise, thanks for your time, Cherie. I look forward to next time.
Thank you very much.
Yeah, I mean, obviously that's music to my ears to hear something like that. And we've just been wondering and discussing on this show. We just had an 8.6 measured inflation, official, right? So my assumption is always that the unofficial or reality is worse. And yet we haven't seen this surge. Why do you think people haven't been so responsive to these almost unthinkable inflation numbers a decade ago? If we were going back a decade, we wouldn't have expected anything like this.
Yeah, it is interesting. I mean, there's a couple of reasons. I think the first, and this gets to gold's fundamentals, I think the first reason is the economy was still growing, the stock market was still going up through 2021. So that's important to understand. When the economy is doing, well, at least statistically, and the stock market is going up, that's going to take capital away from gold. The other issue is it depends. Gold follows the inverse of real interest rates the majority of the time. It depends. If you do a simple calculation and you just look at, the Fed funds minus the CPI, that shows that real rates were still going down. However, if you calculate it from the tips market, where we're looking at the yields on tips versus the yields on the corresponding nominal security,
right?
And that's what everybody follows now. But those real rates actually bottomed, I think, like March of 21. And so when they bought, gold should have peaked in March of 21. So gold peaked about, 6 or 7 months, 5 months, whatever it is. Gold peaked too early. Like it should have kept running. So that's, I think, the one fair quibble. But, once real rates bottomed, that was going to put pressure on gold, just from the standpoint that, real rates, even though they were super negative, the market was seeing them as bottoming. and that they were going to rise ultimately. And I mean, that's what we've seen over the last couple months or so, even the last couple of days. Real rates have been screaming higher. But the good news for gold is, so yes, gold peaked way too soon. It should have kept rising with real rates, which were falling. However, if we look at the last 5 or 6 months or so, the last couple of days have been rough for gold, but gold is only 12 or 13% off its high. And real rates, as far as the tips market, I mean, they have increased significantly. They're something in the last, I don't know, 6, 7, or 8 months. I don't have the chart, but I mean, the real 5-year yield is up. I think it's up like 2.7% in that time frame. So the negative side is, yes, gold should have performed better. It should have peaked. I mean, it should have kept running for at least a few more months. But the positive side now is, and I posted this on Twitter. I retweeted a great chart where you can see that gold has kind of been decoupling from real rates. So very recently, gold should be performing worse than it is. So I think, you look at the fact that real rates have increased significantly recently, and gold hasn't really fallen apart. The dollar has been screaming higher. So gold has actually been holding up really, really well. And that's a precursor to what is coming. I know it doesn't seem like gold has been holding up because it's still a good amount off its high. Silver has, then the gold stocks and the juniors have obviously, they've performed even worse. But those things aside, in the very big picture, gold recently, I mean, if you told me real rates were going to be up 2.7%, I would say, okay, gold's going to be definitely below 1,700, probably in the 1,500s. So that's a really good sign. And again, the trigger is going to be when the Fed stops, because when the Fed stops hiking rates, historically, that's when real rates peak, and then they start to roll over as the market anticipates cuts. So we're not there yet, but I think we're pretty, we're 2, 3, 4 months away from that. Like, we're really close, and that should coincide with gold bottoming and then rebounding, along those same lines.
Yeah, and your note of these two numbers of 3,000 and 4,000 US dollars is not outlandish. In fact, I think about a year ago, maybe more, we had a guest who had authored a post with the CFA Institute, so a very mainstream organization, suggesting 3,000 was likely. And he was actually thinking it by the end of 2021. So we're late, according to his calculation. Now, I'm assuming that on the Daily Gold, you do focus on particular companies as well.
I focus.
Yeah.
Yes.
So how, assuming you're looking at the gold and silver prices a great deal, then you also apply your technical analysis to the companies under the umbrella?
Well, I do. I mean, the companies, the technicals tell you when to buy, fundamentals of companies tell you what to buy. So that's how I look at it.
Right. And, Jonah, we interview mining executives all the time on this show. Do you want to point us to how to cut the wheat from the chaff, right? So the GDXJ has had a terrible time this year. I mean, it's brutal. It's down about a third, maybe 40%. I can't remember right now. And so if you're going to try to make gains in that environment, you better be selective. What's a first step for narrowing that field down?
Well, I think it depends on if you're looking at, what type of company. Do you want a production-oriented company or exploration? Because they're quite a bit different. And I tend to skew towards, I like developers and producers that have potential for really significant production growth, because that can, if they're increasing their production, while you get a gold move from 2,000 to 3,000 or 4,000 in 2 or 3 years, that's really huge for companies that are growing their production. I mean, obviously. And so I like to look for those companies. I like to look for management that has built a mine before. So that's what I look at those. I also look at some exploration companies, but I think that a lot of juniors, I think they're still going to struggle until we see gold surpass that
past high, the 2030 or so?
Yeah. For the most part, I was kind of thinking, I mean, maybe when, gold surpasses 2000 or 2050, whatever it is. But yes, for the most part, I think when we see gold make that new all-time high, that's when you'll see juniors of all stripes really start to catch up to gold. So I think, it's been tough because if you're looking at the last 2 years or the last 18 months, the 3 or 4 months, every company is going down, and it's really hard to differentiate. And I think we'll see the boomerang of that when gold breaks out. It's trading above 2,000. Silver will start moving, and then everything will start moving up again, and the money will just be flowing into all these different companies. But yeah, the trick is you want to try and find the ones that can go up the most with the lowest risk. So that's why right now I'm kind of skewed towards producers.
Right. And Junum, this is your field, this, obviously technical analysis. How much of a herd mentality will come into play? Let's say we get some kind of breakout. Does that just mean every man and his dog suddenly starts to pile on, even though it's late in the game?
Well, I think so, but here's the thing. I don't think it's going to be late in the game, because if I think gold is going from 2000, publicly I've said I think it's going to double. So I have a $4,000 target before the end of 2024. But also, if you go back to what I said about these historical patterns, these historical cup and handle patterns, that when you get these breakouts, they tend to run even farther than the log target. So ultimately, I do think, whether it's, 5, 6, 7 years, whatever, I do think we're going to see gold go much higher. But I'm just focused on the next couple of years where I think that, okay, gold could probably run to 4,000. Maybe it'll go to 5,000 before we get some kind of sharp correction or little bear market in there. And so that's my focus. And so same with the companies I'm looking at. Okay, how much value can they really create and drive over the next 2 or 3 years? I think if you're thinking 4 or 5 years with juniors, that's a little too long. So that's another thing I like to look for with the companies. Okay, where can they be in 2 or 3 years? How does their plan and the potential for them to achieve that, how does that fit into where, what the market can do over the next couple of years?
Right. So your point is basically that even if we start to see a bit of a breakout, there's still plenty of upward potential. That don't think it's too late to get into the game.
No, absolutely, because there's always laggards. And silver, depending on how how we bottom, and how the market turns up, silver tends to start really outperforming gold after gold makes a significant breakout. So for the most part, if we see gold back up at 2000, 2050, you're still going to be able to find, I think, incredible value in a lot of silver stocks. So that's always one place I like to go when the market looks like when gold is heating up. It hasn't really run away yet, but it's heating up, and silver's moved a little bit. That's always a place where you can be really patient and find value in silver. You can wait for gold to move and make that breakout, and then get into silver. And I think ultimately, looking beyond that, I think gold is going to do really well because the economy is not doing well. It will pull up silver, which, silver has the industrial component, but there is a cycle. After gold and silver move, they make a big move. We get closer to the point where maybe the economy will start bottoming. That's when you can look at copper and other things. So there is a cycle to how these things perform. So that's how I would play it. Here and now, I think gold, I'm heavily invested in gold, not so much in silver yet. But I would look for gold to outperform first and foremost. And also gold producers, even junior producers that are producing and they're generating cash flow, some of those stocks are holding up better. Those are the ones that are going to perform the best first. And then, once we see gold make that breakout, capital will flow to, the developers and then the explorers and silver. So yeah, it's important to understand, how it could play out as far as, which groups are going to outperform and when, and how the capital moves from, each to each.
Right on, folks. You've been listening to Jordan Roy-Byrne. He is editor-publisher of The Daily Gold. That's thedailygold.com. You can also find him on Twitter at The Daily Gold. So he's got a lovely Twitter handle there. Jordan, mate, pleasure to speak with you. Thanks for checking in.
Hey, thanks so much for having me. It was a real pleasure to be on.